Statement of profit or loss, another comprehensive income for the year ended March 31st, 2023. That's A. B. Statement of changes in equity for the year ended March 31st, 2023. C. Statement of financial position as at that date. Additional information. The land and building were purchased 15 years before the beginning of the period. The cost of the land was 350 million. No land and building have been purchased by Conco Below PLC since that date. On April 1st, 2022, Conco Below PLC had its land and building professionally valued at 400 million and 875 million respectively. The directors wished to incorporate these values into the financial statement. The estimated life of the building was originally 50 years, and the remaining life has not changed as a result of the valuation. 1. Later, the estate valuer, Messrs. Ajasoko and Company, informed Conco Below PLC that investment properties of the type owned by Conco Below PLC had increased in value by 7% in the year ended March 31st, 2023. Plant and machinery other than the leased plants stated in II below is depreciated at 15% per annum using reducing balance method. Depreciation of building, plant, and machinery is charged to cost of sales. On April 1st, 2022, Conco Below entered into a lease for an item of plant which had an estimated life of 5 years. This lease period is also 5 years with annual rental of 110 million, payable in advance from April 1st, 2022. The plant is expected to have a new residual value at the end of its life. If purchased, the plant would have a cost of 460 million and be depreciated on a straight line basis. The interest rate implicit in the lease is 10%. The loan note was issued on July 1st, 2022, with interest payable 6 months in arrears. The provision for income tax for the year to March 31st, 2023 has been estimated at 141.5 million. The deferred tax provision at March 31st, 2023 is to be adjusted to a credit balance of 70.5 million. The inventories at March 31st, 2023 were valued at 216 million. That's all, sir.
The main body. The main body.
The main body. Question. The following is a trial balance of Conco Below PLC for the year ended March 31st, 2023. Land and building, 1,350 million. Figure in million. Plant and machinery, investment. Plant and machinery, 780. Investment property, valuation at April 1st, 2022, 450 million. Purchases, 391 million. Operating expenses, 78 million. Loan interest paid, 10 million. Rental of leased plant, 110 million. Dividend paid, 75 million. Inventories at April 1st, 2022, 189 million. Trade receivable, 266 million. Revenue, 1,300.
All
Yes,
are in
sir. All are.
debit. Assets and expenses, they are all in debit. Continue.
Revenue, 1,392 million. Income from investment property, 23 million. Ordinary shares at ₦1 each. Fully paid, 750 million. Retained earnings at April 1st, 2022, 598 million. 8% loan note, 250 million. Accumulated depreciation at April 1st, 2022. For building, we have 300 million. Plant, 130 million. Trade payable, 167 million. Deferred tax, 62 million. Bank overdraft, 27 million. Total, 3,699 million on the trial balance and its balance.
All the other ones from revenue down to bank OD are all credit items on our trial balance. The land and building is an asset. Plants and machinery is an asset. Investment property, opening balance is an asset. Purchasing is an expenses. Operating expenses, just as the name sounds. Loan interest paid is an expenses. Rental of lease plant is an expenses. Dividend paid is an expenses. Inventories at 1st April is an opening balance. That's opening inventory. Trade receivable is a current asset. It's an asset. So you can see that all assets and expenses are under debit balance. Revenue is an income. Income from investment property is an income. Ordinary share capital is share capital. Equity. Retained earnings. Opening balance. April 1st. On the credit side. 8% loan note is a debt. Non-current liability. Accumulated depreciation is on credit side. It's a liability to reduce the assets to get the carrying amount for the period. And this accumulated is opening balance for building and for plant. Trade payable liability, it's a current liability. Deferred tax, it's a liability. Bank OD, it's a liability. It's a liability. Now, what the question is asking us to do is what we will go straight to. We'll start with the statement of profit and loss and other comprehensive income. For the year ended 31st March 2023. But like I told you, in the presentation or the preparation and presentation of a financial statement, which consists of financial position, statement of financial position, statement of profit and loss and other comprehensive income, and statement of changes in equity, so say, and others, notes to the account, and the rest. We need to do adjustments for the following. That is the additional information. We need to calculate all these adjustments, though we will call them workings, but they will serve as our notes to the account. That is what I told you. It's going to serve as notes to the account. So we will meet with the law or the standard IAS1 that provides that we should, present our financial statement. We also meet up with IAS8 and IAS10 that talks about adjustment or event occurring afterwards the reporting period. So we need to meet up with this standard one way or the other through this additional information. So we will start with the first additional information. The revaluation from 350 to 4 million will give us 15 million revaluation surplus. The depreciation is 100% over 50 years, which is equals to 2%. The carrying amount for building will be cost minus accumulated depreciation, which is 1,000 cost, or 1,000 million cost minus 300 million accumulated depreciation, which is the carrying amount will be 700 million. It will be 700 million. Now, and it means it was revalued up to 875 million. It was revalued up to 875 million, and which is now have a revalued amount of 175 million to be added to the cost. So now we can see that we have been able to calculate that of land and building, the revaluation amount and the depreciation therein. Investment property was also revalued, or the fair value increased by 7%, which is 1.07 multiplied by 50. As it is on the board, that will give us 481.5 million. The 7% is the difference between 450 and 481.5 million, which is 31.5 million, as written on the board. And this will go to our income. It will go to our revenue. Well, it will serve as an other income in our revenue. That income came as a result of status. Then working 1B, which is also on the additional information, we were told that the plant and machinery is depreciated at 15% of the reducing balance. As well, we are using the reducing balancing method of depreciation to calculate it, which is 780 cost minus 130 accumulated depreciation, and that will give us 650. Multiplied by 15%, it will give us 97.5 million, which is now the depreciation for plant and machinery. We are now going to prepare our movement of change in PPE. and apply the following and some other information that are in the what's it called, that are in the additional information, like the lease property that will be purchased at the end of the period at 460, and that one will be included as addition to our movement of change in property. Now, in preparing our movement of change in PPE, we have land, building, plant and machinery, and leased plant subsequently purchased during the year, and total from 1st April 2022, we have a brought forward of 350, 1,000 million, 780, and no brought forward for leased plant that was purchased. Total 2130. Then we have evaluation of land 50 as calculated in working one previously. We have for building 175, no revaluation for plant and machinery, no revaluation from lease plant purchased. The total of revaluation is 225. Then we have addition. No addition for land, no addition for building, no addition for plant and machinery. But we have an addition for lease purchased of 460 million. Total 460 million. Then we have the total cost as at 31st March 2023. You have for land and building 400, for the land 400, building 1175. Then we have plant and machinery 780. Then we have lease plant 460. Total 2815. Therefore, depreciation. For depreciation on movement of change in PPE, we have brought forward at our 1st April 2022 for land, nothing. For building 300, for plant and machinery 130, then for lease plant, nothing, 430. And this is what we have in our trial balance. Now, we calculated for current year depreciation for land, nil, for building, 23.5. For building, 23.5, which is 2% of the cost, and that is 23.5. Then we have 97.5 for plant and machinery as calculated previously in working B. In working 1B. Then we have for lease plant, which has a useful life of 5 years. We have 92. That is 460 million divided by 5 years. You have 92 million. Then we have total of 163. We have total of 163 as our, depreciation. It's not 163. There's an error there. It's not 163. So now the total for the depreciation for the year is 213. If you have the total depreciation both accumulated and current year, you have for land nil. Then for building 223.5. For plant and machinery 227.5. For lease plant purchase, you have a depreciation for it as at 31st March 2023. You have 92. The total for everything is 643. Then we now have a net book value or carrying amount as at 31st March 2023. For land, we have 400. That is 400 cost minus new depreciation, accumulated depreciation for 2023. Then for building, we have 951.5. Then we have for plants and machinery, we have 482.5 as carrying amount. Then for lease plant purchased, we have 378, giving us a total of 2172 million. And this is what we will take to our financial position at the end of the day as note 2. What I'm saying is that the lease plan, that is additional information 2. The lease plan, we need to calculate the outstanding lease balance at the end of year 2023, and that will be the lease plant amount of 460. Then we were told that we will pay 110 million in advance. That will be a balance of 350, because there is an implicit cost or interest that is added to that 350, which is 10%. We'll add 10% to the 350, then we will get 35. That 35, we go to our P&L and other comprehensive income as interest paid, that finance cost, and the total amount that will be outstanding as liability, lease plant liability, will now be 385 as it is on the board.